You identify a clean structural level, mark out your order block, and wait patiently for price to retrace and test it. But instead of bouncing cleanly off the top boundary, price slices straight through the zone, plunging 80% deep into your outline structure. This rapid downward thrust pierces directly into the tight clusters of protective stop-loss orders placed by early buyers. Immediately after triggering those stops, the market reverses, rocketing upward and leaving you stopped out of a trade that proceeds to run straight to your original profit target. Standard retail technical analysis typically labels a penetration this deep as a failure, assuming the level is no longer valid. Believing the setup is broken, most traders abandon their original directional bias entirely. To understand what actually happens at these levels, we have to look past surface-level price action and examine market microstructure. That 80% plunge represents a calculated institutional liquidity sweep. In institutional order flow, this specific engineered event is known as the Deep B-Wave Shakeout. We are going to map the exact mechanics of this trap and construct a mathematical framework to trade the reversal. Success in these zones depends on learning to identify the precise difference between a genuine structural break and an engineered sweep. Large institutions face a mechanical problem. They need to accumulate massive positions, but the market rarely provides enough counterparty volume for them to enter all at once. This split-screen model illustrates two distinctly different retracement environments. On the left is a shallow B-wave momentum pullback, which early retail traders typically favor when chasing a breakout. These brief, shallow dips lack the volume of counterparty sell orders necessary to absorb heavy institutional buy limits. If a large fund attempts to execute their massive buy orders here, their own demand will artificially spike the price against them, ruining their average entry cost. Looking at the right side of the model, we see the origin of the initial upward expansion. We will define this structural base as the genesis block. To find the necessary volume, institutions allow price to drift backward until it retraces 75 to 90% deep into that original genesis block. Pushing price into this extreme discount zone forces early retail buyers to panic and capitulate. That capitulation translates directly into a cascade of automated market sell orders hitting the tape as stop losses trigger. Those concentrated retail sell stops provide the exact counterparty liquidity the institution requires. The incoming wave of panic selling is neatly absorbed by the institution's resting limit orders, allowing them to fill massive positions at a steep discount without moving the market higher. This precise moment of maximum absorption occurs exactly when the retail trader assumes the upward trend has completely collapsed. The retail seller exits in chaos, while the institutional buyer patiently accumulates inside the lowest 20%. The execution dilemma is clear. Buying into an 80% plunge carries extreme risk if the level is actually failing rather than sweeping. To navigate this, we apply a mechanical execution system designed to measure volatility tension, the rubber band snap framework. This structural map defines Step 1, location validation. We require price to firmly cross below the 50% equilibrium midline of the genesis block. Slicing through the midline confirms that retail capitulation is underway, but it is too early to risk execution. Step 2 is tension measurement. We wait for price to reach maximum adverse excursion, stretching deep into the bottom 25% discount zone. At this stage, a strict negative constraint applies. You must never place blind buy limit orders while price is still falling through this area. Step 3 is the snap. Execution requires dropping down to lower timeframe data to confirm that institutions are actually stepping in to absorb the selling pressure. We look for a specific lower timeframe confirmation signal known as the True C matrix. This dashboard tracks the first required variable of the True C matrix, a localized volume surge printing well above the moving average baseline, confirming sudden, heavy participation. The second required variable is a momentum hook. The downward price velocity must instantly flatten and curl upward, proving the volume surge was absorption, not a continuation of the dump. The simultaneous alignment of the extreme structural location, the volume surge, and the momentum hook forms your mechanical trigger to execute. Mandating lower timeframe volume confirmation removes the emotional impulse to guess the bottom, transforming a chaotic drop into a precise reactive entry. Quantitative and institutional traders target this specific setup because of its mathematical asymmetry. This risk geometry overlay maps out the exact parameters. First, we establish the invalidation level, your stop loss. Because you delayed execution until price reached the lowest 20% of the block and confirmed absorption, your required stop loss is extremely narrow, tucked strictly beneath the lowest wick of the capitulation sweep. Your first profit target is the 50% equilibrium midline that price initially sliced through on its way down. Your final macroeconomic target maps back to the origin peak of the initial trend, creating a massive expansion zone above your entry. This specific geometry generates a stark risk-to-reward asymmetry, routinely offering a 1 to 4.5 return profile. This mathematical profile is statistically superior to buying the initial shallow breakout, where stops are wider and upside potential is highly compressed. Trading this methodology involves looking past simple price action to see the underlying liquidity mandate. Deep retraces are the primary mechanism for institutional order fulfillment. Retail traders obsess over precise price points, while institutional traders focus entirely on where liquidity can be engineered. Market mastery requires abandoning anticipatory guesses at the top of structural zones. Wait patiently for extreme location, verify the volume tension, and execute on confirmed absorption.